Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Thank you for joining us for this next edition of the Global Financial Markets Podcast. I'm Holly Bunting, a partner based in Washington, D.C. in Mayor Brown's Finance Group, and my practice concentrates on consumer regulatory compliance matters. Today, I want to address home equity investment contracts, explain briefly the typical structure of those products, and provide us an update on the regulatory considerations related to these products. These are a product that have become popular in the past couple of years in response to higher interest rates and thus higher rates for home equity lines of credit. These home equity investment contracts have filled a niche for a different kind of product for consumers who are looking to tap into the equity in their home. So what is an HEI contract? It's essentially a real estate option contract. And these contracts are often structured as real estate option contracts where the HEI provider is making an upfront payment to a homeowner in exchange for an option to acquire a percentage interest in the property at a later date. And then the remaining portion of that option payment is paid at the time of the option exercise. An option exercise can happen under a number of circumstances. If the consumer decides to sell the home, or if they want to refinance an existing first lien on the home, or the expiration of the contract, whether it be a 10-year contract or a 30-year contract as an example, or if the consumer wants to just repurchase that option, they can request an early settlement under the contract. The idea, though, is that once these contracts are exercised, the value of the home is either increased or it's decreased. And the HEI provider is acquiring a set percentage of the property value. So if the property of the home is increased, they will share in the appreciation based on that percentage. Or if the property value has decreased, then the HEI provider also shares in that loss. A lot of these products will contain what we often see referred to as a risk adjustment, and that could range anywhere from between 2 and 25% of the actual value of the property. And that's intended to reduce the strike price from which gains or losses are measured when the contracts are settled. These products may also contain an annual return cap that's intended to protect homeowners from exposure to sharing significant gains with the option holder to the extent the property has significantly appreciated. And then these contracts are secured by a mortgage or a deed of trust to the property. And again, these are often second liens to the extent the consumer continues to have a mortgage on their home. So what I described is often what we see as a real estate option contract. These are also structured to be forward sale contracts or home equity appreciation contracts. And it's essentially the same concept, but the way that the contract is put together is slightly different. So rather than purchasing the option and paying a purchase price for that option, in exchange for selling a right to purchase a percentage ownership in the consumer's home in the future upon the occurrence of certain events, then there's an investment amount or a purchase price that's paid, and that's equal to a certain percentage of the home's appraised value. Again, the contract can be exercised in many of the same circumstances I already described. And once one of those events occurs and the contract is exercised, the contract holder's percentage ownership in the property is equal to a multiple of that investment amount that they have paid upfront, which again was a percentage of the home's initial appraised value. So for instance, let's say that investment amount was 15% of the home's initial appraised value. The contract holder's ownership at exercise is 22.5% of that appreciated home value. And that's effectively a 1.5 multiplier. Again, other features of the product are very similar to the real estate option contract that I described. And of course, there's a second lien on the home. secured with the contract. One of the primary regulatory considerations that comes up when we're talking about and thinking about HEI contracts and what those risks look like is whether or not these contracts might be recharacterized as a mortgage loan. Again, these are structured to be real estate option contracts or forward sale appreciation contracts. But the question is whether or not they could be construed as a mortgage loan. And if so, then there are many federal and state laws that would become applicable to these products. So as an example, the Federal Truth in Lending Act applies to credit. And credit includes two important exclusions when you're looking at the Federal Truth in Lending Act. One is for option contracts, and another is for investment plans where there's a risk of loss to the capital that's invested. These two exclusions from the definition of credit are very much what HEI providers hang their hat on to make the case that these are not loans, these are not credit, and they're not therefore subject to the Federal Truth in Lending Act. There is favorable case law to support that position. There was litigation in California in 2017 that involved an HEI product offered by Equity Key. And in that case, the court decided and considered whether or not the product at issue was credit under the Truth in Lending Act. And it points to both the investment plan exclusion as well as the option contract exclusion to support the fact and the court's ultimate determination that that product was not a loan, that it was in fact a real estate option contract. And there have been a few other cases that have looked to that decision in California to support similar findings or characterizations of these HEI option contracts as real estate options and not mortgage loans. The CFPB, however, is the federal regulator that is responsible for the Truth in Lending Act, as well as a variety of other federal statutes that relate to mortgage loans. And they've taken a look in the past at other alternative credit products and reached the conclusion that those products were, in fact, credit. There were two settlement agreements issued in connection with income share agreements. The CFPB, prior to the new Trump administration, also had issued guidance taking the position that earned wage access products were, in fact, credit, despite the fact that they had taken a contrary position in view of those products in the past. So there is some concern from a recharacterization perspective that the CFPB could view those products as credit. And in fact, in a parting blow, before the Biden administration left the CFPB, there were a couple of actions that they took the week before President Trump's inauguration directed to these HEI products. The first thing that they did was they introduced or they released a mortgage markets report, which took a pretty balanced look at the HEI market and the structure of the products and the way that they work in the marketplace. They also issued a blog post, which was attached with a consumer advisory. And that document essentially highlighted the negative features of HEI contracts and invited consumers to make complaints to the extent they felt they had been harmed. And then the other thing that they did is they filed an amicus brief in existing private litigation involving a particular home equity investment originator. And they took the position in that brief that the product being offered by this provider was credit because it deferred debt, and it did not qualify for the investment plan exclusion from TILA. It was quite a short analysis. There are plenty of things that analysis did not address. And in subsequent reply briefs in that litigation, both the defendant as well as a trade association representing HEI contract providers provided some very good arguments as to why the CFPB position was not correct. Fast forward a couple of weeks, and the Trump administration is now in charge of all actions at the CFPB. And on February 19th, the CFPB filed a motion in that litigation in New Jersey to withdraw the amicus brief that they had submitted. The next day, the court granted that. But the court did not remove that brief from the record. It indicated that while it acknowledged that the CFPB stated that the brief no longer represented the CFPB's current views as to the products in question, that it would leave that brief on the record. Also, on February 21st, the CFPB removed that blog post and that consumer advisory that I mentioned. They took it down from their website. It's no longer there. They did, however, leave up the mortgage market update that describes the general HEI industry generally. So ultimately, there certainly was a lot of concern in the middle of January that the CFPB was taking a position, while not binding, that could certainly draw a lot of attention to the HEI marketplace. They've now seemed to have reversed course, and at least we have an indication from the Trump administration that they don't share the views of the Biden administration from CFPB as it relates to the HEI contracts, or at least that they're taking some time to reconsider what their position is on the particular product. So at this point, we sort of go back to where we were at the beginning of 2025 before the CFPB issued these particular documents. Certainly, there are states that could take a look at these documents and use them as persuasive authority and reasoning for making determinations about their own regulatory requirements. There's also a concern that plaintiffs' attorneys may use the CFPB's opinion as a way to pursue these types of claims against HEI originators from a consumer protection perspective. But at the end of the day, the law as it stands is we have favorable case law that upholds these contracts as being excluded from the definition of credit. So that's an important consideration when you think about the overall regulatory structure of the product and whether or not they could be recharacterized as loans. The federal landscape, though, is not the only place to look. We also have to consider the states. And the states have, some states have been very active as it relates to HEI contracts. A few states have explicitly amended their mortgage licensing statutes to treat shared equity or appreciation agreements as mortgage loans. And so that, of course, requires mortgage licensing, and it requires compliance with mortgage statutes and regulations in those states where those laws have been enacted. Those include Connecticut, Maryland, and Illinois. There's also states with pending legislation that would attempt to regulate HEI contracts at the state level. Right now, there's legislation pending in Washington state as well as Massachusetts. And those proposals are pretty similar in that they would create a separate licensing structure and regulatory structure for HEI contracts that's separate from the mortgage law. So they would not define HEI contracts as mortgage loans, but they would establish a regulatory framework for licensing, disclosures, and other substantial compliance requirements as it relates to those products.
That said, there's been another bill introduced in Massachusetts which proposes to amend the state's mortgage licensing law and include shared appreciation agreements in the definition of mortgage loan. This approach is similar to the approach that's been taken in Connecticut, Maryland, and Illinois. Both approaches to the regulation of HEI contracts in the proposed legislation have been referred to committee in Massachusetts and are working their way through that legislative process.
There's also some states that we know have informally taken the position that these products fall under existing mortgage laws. Again, there's no official guidance or announcements by these particular states, but based on various HEI's providers' activities in the marketplace, we know that Georgia, Colorado, North Carolina, Washington, and Wisconsin have taken the position in the past that they view their existing laws as covering these HEI products. So in addition to the legislative front, we also have had some recent activity on the litigation front from the states as it relates to these products. In February 19th, 2025, the Massachusetts Attorney General filed suit against an HEI originator and alleged various violations of Massachusetts law. That included everything from allegations of usury violations, loans being made without regard to the state's requirement to consider the consumer's ability to repay, also the state's requirements as it relates to reverse mortgages, and then the allegation that the true nature and cost of the product had been concealed from the consumer. So we're obviously at the very early stages of that litigation, and there's no way really to predict where it's going to go. But Massachusetts is certainly on record with this litigation in making their stance clear, at least with regard to the Attorney General, that they believe these products are in fact loans and should be regulated that way under Massachusetts state law. So there's a lot happening. We expect that perhaps more and more states will begin to take a look at this product. Certainly, the companies themselves have organized as a trade association to create, I think, a unified message on the nature of the products and how they should be regulated. And so there's more to come. But as it is now, again, I think from a recharacterization perspective and those types of regulatory considerations, there's certainly law to support the notion that these are option contracts and not loans. Certainly, the facts of the particular products and the way that they're marketed to consumers can create risk in that regard. There's always an opportunity to consider unfair, deceptive acts and practices requirements and how these laws are marketed to consumers. Are they marketed like loans, or are they marketed as an option contract? Do consumers receive disclosures to make sure they understand the terms of the contract? Various other protections that might be offered by these originators to make sure that consumers have a chance to understand and consider, and even a chance to cancel the product after origination if they change their mind.
Ultimately, we expect the regulatory landscape to continue to evolve as it relates to HEI products, and Mayor Brown will be tracking those developments. Thank you for your time and attention.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.